Hi everyone and welcome back to Rogue Green. I am Francesco De Lieto, with us our co-host Emma Mee. How's the week going for you, Em?
I don't know yet, Francesco. You've brought me in to talk about insurance. Can I tell you after this?
Well, it's about carbon credits insurance, so it gives that climate interest. No?
I do have a view about insurance, and I do think that these little intro spiels are my opportunity to have a little rant if I'm going to at any point before we obviously bring our guest into this. I have had thought about insurance over the years, I'll be honest, because it feels that the insurance sector as a whole is in an incredibly privileged position because, particularly related to climate stuff, they are absolute masters of risk. Right? They're able to look forward in very long time frames. They're able to analyze and assess risks and ultimately to communicate it, and more importantly, to price risk. So it feels to me that climate change and insurance should go hand in hand in terms of the expertise and the people that are involved. But there's another crucial factor, which is insurance companies give everybody else in the world, every other business, a license to operate. So this has driven me mad because 25 years ago, I am that old, we were working with the insurance sector and they were sort of picking up the game a little bit with regards to bringing their skill sets to climate change, to start to price risk, to start to talk about why are they underwriting oil rigs, for example, when they are also having to pay out huge amounts of money to the natural disasters. There's a complete sort of tension in their entire business model. And they were being quite open and quite forthcoming about that. But for some reason, they sort of went quiet and went away. And these days, if I speak to anybody in the insurance sector and try and pin them down on a bus about this, they seem to think that they're sort of coming across the issue almost for the first time, which is really frustrating. But you're right, that is general insurance, and we're going to talk more about insuring the good stuff, not the bad stuff, aren't we?
Yes. So today we're diving into one of the most contentious, actually, but crucial arenas in climate action, which is the voluntary carbon market. Something that is valued about 4 billion today, and it is estimated it could reach nearly 24 billion by 2030. Some say more, some say less. But despite this growth potential, trust has been eroded. Transaction volumes fell sharply in 2024, and headlines keep raising doubts about whether carbon credits truly deliver what they promise. Will there ever be a proper carbon market, or is it a bubble that is ready to pop? This is why today we're joined by Chris Slater, the CEO of Ciiiao, the carbon insurance company. Think of Ciiiao as a kind of risk translator. Chris is here to unpack how insurance can bring performance, financial and reputational clarity into a market that desperately needs it. Are they simply a fix for systemic failures, or the pivotal enabler for a credible carbon market? Chris, welcome to Rogue Green. How are you doing today?
I was good before those intros. They're big questions that I will have a go at trying to solve.
Okay, thank you. Bye.
I love the fact that Emma's already putting the question of the entire thesis of insurance on the table up front.
Yeah, we'll start big.
Exactly. So hopefully I can go some way to showing that the industry has a important role to play, not only in climate, but for hundreds of years has been providing a social good. As you said, Emma, it enables risks to take place, whether as an individual or as a corporate. So hopefully we can try and tackle some of those questions today in relation to the carbon market.
All right, Chris. So at risk of getting out of my depth fairly quickly in this conversation, we'll start simple, right? We're looking at carbon credits. Okay, so this is something which I know my investors have always been a little bit off about. They're not sure that they're here to stay. They're not sure they can trust them, in the suggestion that they can invest in startups, for example, that do things that rely on carbon credits to be part of their business model or their revenues going forward. Nobody's quite sure. So tell us a little bit about the sort of the market for carbon credits. We know that it's been under fire. We know that it's been in trouble. It's been unreliable in the past. Just inform us a little bit better on the carbon credit market to start.
Yeah, and there's going to be plenty of opportunity for us to bifurcate markets as we go through this conversation. I think it's probably worth, importantly upfront, to distinguish the voluntary market from compliance or quasi-compliance markets. It's important because I think the criticism on the voluntary carbon market in recent years has really come about because of questions around the integrity of the underlying projects. Are the projects delivering on the promises that effectively a credit is supposed to stipulate? A credit effectively is a representation of carbon being stored or avoided. A ton of carbon, or either stored and removed from the atmosphere, or a ton avoided in terms of its production. And really, those criticisms, I think, we'd say have been fair. They've been lobbied at scrupulous actors within a new and nascent market. They've been criticisms around the social benefits of these projects. There's been criticisms around the permanence of the carbon storage. But I'd sort of put up front to our listeners is that no market is perfect. In fact, the imperfection of market is what drives markets to continue to develop and evolve. And this is a relatively new market. Whilst the voluntary market has been around for 20 years, in terms of its growth, in terms of the projects, in terms of the investment, still relatively nascent and immature. And I think these criticisms have helped in terms of identifying areas that the design of this market, this voluntary carbon market, and areas that need to improve and are now being tasked and being challenged to the market and now being solved by the constituent parts. But, and I put a but again up front, is that voluntary carbon market and the voluntary credits that are purchased are voluntary actions. They are not compliance requirements. These are corporates that I think have admirably set goals and targets, many of them, to achieve decarbonization levels. And they have set these goals and have looked to try and achieve them by, importantly, decarbonizing first. And again, I always at odds to say it isn't one or the other. You decarbonize first, you do the work to try and reduce your emissions as an organization. And then really carbon credits are an opportunity to offset residual emissions. So it is the combination of all those pieces that should allow a carbon market to prosper and should allow corporates to voluntarily go in and purchase credits. But there's problems that we need to solve in the market that I've highlighted, the integrity of those projects, and how do we solve that? We as an insurer are we're not a silver bullet, but we're trying to apply the tools and techniques and skills that insurers have used for many years to assess the risks of projects, to try and take some of that risk off the table and allow capital to flow into the market, and hopefully scale some of these projects to meet those decarbonization targets.
So, Chris, you touch already a very important point. Why should anyone trust that 1 ton purchased really equals to 1 ton removed or avoided? And how does insurance change that story?
Well, I don't think insurance solves that question. So
okay.
Just to be clear, if we go to the fundamental question of should we be investing in carbon projects and should we be encouraging corporates to set goals and try and meet them by having a vehicle of directing capital to decarbonize, I hope we'd all agree that that is a viable ambition and corporates should have a mechanism to potentially go that way. I would be, again, counter arguing for a carbon tax that forces it more as a stick rather than a carrot, but maybe again, that's a conversation we can pick up later in this conversation. But we need a mechanism and a way for corporates to invest, and we need a vehicle, and the carbon market is one vehicle to do that, to direct capital towards projects that are trying to, whether it's clean cook stoves and the replacement of 2 billion people are still cooking on open fires globally. Without carbon finance, the ability to replace that in local communities with a cook stove that is $40, without carbon finance, those projects don't get going. So at a fundamental level, we need a mechanism to be able to do that. And the generation and creation of carbon credits is a way of doing that. I haven't heard any alternative ways to try and address those problems than carbon markets. So carbon markets is a very viable mechanism. Are there problems with them? Yes. Is there challenges around ensuring that the projects are doing what they should be doing? Yes. But no market's perfect. The financial markets are imperfect, and there are ways and there are constant, increases and improvements in regulation to improve them. And the carbon market is another market that I think is a viable way of directing climate finance towards projects.
No, I mean, it sounds complicated, right? So I just sort of want to ask, how is Oka approaching this? How are you turning that uncertainty into something which you can genuinely measure and ultimately ensure?
Yeah. So we see our role as a way of more adequately allocating risk in the market. So if we take a step back, 3-4 years ago, there was no insurance that existed within the carbon market. So what did that mean? Well, if you're a off-taker, i.e. a buyer of carbon credits, and you're looking to buy credits from a project, let's take a clean cook stove project in Rwanda. Okay, how can you ensure that the credits that are delivered equal a ton of carbon avoided? Okay, well, you buy credits from a recognized registry. So let's take Vera as the largest. I think 80% of credits still today are generated. And you are contracting with the developer to ensure that those credits are delivered to you. And then the developer is going through the adjudication methodology appraisals with Vera, and Vera is adjudicating and issuing those credits so that the corporates can buy these credits with an assumption that they followed the science and that credit is stored. If you look at the contractual relationships between those three parties, there's risks that exist across all of those relationships, whether it's between the buyer of the credit and the developer, that the developer is going to do what they say they're going to do. They're actually going to give them and sell them the credits rather than fraudulently selling them pieces of paper that don't mean anything. Well, there's risk there. Does the developer take the risk or does the buyer take the risk? There's then the registry and the issuing of those credits, and how do they make sure that when mistakes get made and credits get issued, that maybe a proportion or a fraction of the ton of carbon that's been avoided, how do they correct for that? So really, there's risks that exist across the life cycle of these projects that are generated, credits that are issued, and buyers. What we've done is we've come into the market and say, well, we can take some of that risk off the table. So we can say to a buyer of the credit, look, you're buying these credits and I can ensure against the risk that that developer doesn't deliver on the promise of that contract, that they said they're going to sell you 100 credits and in 3 years' time, they only deliver you 80 credits. Well, there's a loss. Okay, well, we can insure for that. We can't insure against the measurement of that and accuracy of that carbon being avoided in this instance. But we could work with the registry to go, well, if that the science changes or it's found that through an audit that project hasn't delivered that 100 ton of carbon, if you want to put a remedy in there and an adjustment on that credit, again, that's so that there's a loss of carbon stored or avoided, and an insurance could go some way to compensating, but it doesn't provide a guarantee. And I think that's been one of the challenges for us as we've come into the market, is that organizations, whether it's the buyer of the credits, the developer of the credits, or the registries that issue those credits, or investors in these projects, I think they've looked to insurance to really provide this guarantee, this perfect solution. You tell us, if you're willing to insure the credit, then you must be sure that that credit will always equal a ton of carbon. That's a fallacy. Like there is no perfect system. And the problem I think that we've got as a carbon market today is we think we've designed a perfect system so that when a critic and a criticism comes, we're unable to face up to that criticism. But no markets are perfect. Climate and our ability to deliver on decarbonization goals is imperfect. We will never, we can strive towards somewhere. Maybe that's the pragmatist in me. We can strive towards and we can aspire towards, and then we can course correct and we can improve and we can assign, impacts if things don't happen. But there's always risks that exist that this project doesn't do what it says it's going to do. There are risks that are within the control of a developer, and there are risks that are outside of the control of the developer. Some of those can be managed, and some of those are just circumstantial. If you're a reforestation project in Guatemala, okay, there's going to be hurricanes, there's going to be wildfires, there's going to be infestation. Like, you can't design a system that will say guaranteed that carbon will always be stored in those trees. You just can't say that. But the way that the market has been designed today that the buyer of those credits has been told by the registries that those credits will always equal a ton of CO2. And that's just a fallacy that exists in the market today. There's imperfection always within system designs, and insurance can go some way to managing the downside of some of that imperfection, but it can't provide guarantees.
Well, but that is a fantastic thing that you provide. That, hedging on the unpredictability, it is obviously something that the people that are not into the industry don't think about. You talk about, I don't know, credits for the renewable energy, and then you have grid failures, and then you're not able to generate that amount of carbon credits. You have wildfires, bushfires, whatever. You're not able to generate that amount of carbon credits. What I wanted to tell you, though, which is strictly related to one kind of risk that you help to mitigate, which is the performance risk. It is the measurement part, Chris. How can you not look towards that risk? Because everything comes to that, to measure the effective benefit, the effective environmental benefits of that particular project. And how are those measured determined a lot of things. First and foremost, I think also the pricing of the carbon credit. So that it is a very important part that also gives, again, the quality of the carbon credit. What can be done onto the measurement part? How can that be de-risked, that part?
Can you be clear, Chris? Are you insuring the developer or are you insuring the buyer?
We can do both.
You're doing both. Thank you. Carry on.
And let me use the analogy that I use quite often around a construction project. So you're building a hotel, okay? And you will have a buyer of the hotel at the end when the hotel has been constructed. You will have an investor in the hotel, and you will have a construction firm and a variety of other construction firms, but three parties, okay? The construction firm promises that they will construct the project on time and will deliver that 100-room hotel. They will take insurance out. They will bond themselves and say, look, if something fails that is both outside of my control, potentially inside of my control, then there is a loss, and a replacement construction firm could come in and continue that project. Compensation could be given to the buyer of that hotel if it's delayed. But the developer, that construction firm, can be insured. The buyer of the hotel can also be insured because they are expecting to maybe sell that property on. They might have done a back-to-back contract that someone's going to buy it from them before it's finished its construction. They might be selling the hotels up front, the rooms up front. So they will have risks around the delivery of that project on a time. So they can take insurance out. The investor in the project has a risk. They provided capital and maybe a debt facility into the developer or into the project initiator. And if they don't pay that loan back on time because the project hasn't been delivered, then they will suffer a loss. So any one of these constituent parts has risks that are reliant on the work that they do and the returns they want to generate. If we take that to a carbon project, it's exactly the same. The life cycle of a carbon project will have a developer looking to get finance, looking to plant the seedlings of the trees, grow those trees, ensure that those trees are then storing the carbon, getting it measured, delivering on, issuing of credits, delivering those credits to a buyer of those credits 3, 5, 7, 10 years down the line. There's a variety of risks that sit across the life cycle of that project that at different stages, different constituent parts will go, well, I'm holding the risk of this project, and we want to make sure we protect the downside. So just to, again, provide some context from a sort of like comparison with something else your listeners might be familiar with. But I think just picking up on your question, Francesco, which I think is a great one, because it gets to the heart of, okay, can we guarantee that a ton of carbon is stored, and for how long that ton of carbon is stored, and how can you as an insurer ensure that carbon is stored? Like, what are the measurement tools that we use? We can't guarantee it. Let me let you into a secret. No one can guarantee that carbon will be stored, yet the market design today will lead you to believe that if you buy a credit, that credit will always equal a ton of carbon that's been stored. And that's a fundamental problem with the market as it's designed today, that if something happens, you bought that credit, you think that credit will always equal a ton. Well, it won't. It could, sorry. There will always potential be risk. Well, that may impact that ton of carbon. And it could be the science improves. If you look at the storage of carbon within a direct air capture facility, fairly modern technology, very new and evolving space, the science of measurement and the storage of this carbon will always improve. We will always get better, I believe, measuring and ensuring that the carbon that's stored is stored accurately, is stored sufficiently, and stored there for a reasonable length of time. Something could happen, and all the science could improve that actually shows, well, there's an error in the measurement markings, and maybe actually we've improved the understanding of the molecule structures, and actually we've seen that something else has happened. Okay, well, impair the value of those credits then. We've got tools with our toolkit that will allow us to course correct over time if something we believe today changes in the future. But the issue we have is standards bodies in the market today don't do any of that. They don't make any course corrections on credits. They give this impression that credits will always equal a ton of carbon. You buy them corporate, and if an event or an issue happens, they sweep it under the carpet and go, oh, don't worry, we've improved our methodology, buy some new credits now. Those old credits, they let the market from a pricing standpoint do the course correction. That's an imperfect design.
But that is a methodological uncertainty, and since you said a few minutes ago, it is 20 years that there is this market, and we're not talking about little money, okay, involved into that, with projections destined to grow according to many. Why are we still? I do understand on hard tech like direct air captures and others, it's fine. You have a meter, you're able to quantify with a fairly high degree of certainty, and that's why they're also priced the way that they are priced. But on some others, we're still debating how many kilos of CO2 a tree absorb per year. And it is something that how do you account for that when you insure on performance, for example? Can you account for that? No, you can't, because you just said we're still back onto the methodological uncertainty, and that raised also. I do like a lot what you're doing. It is pretty ballsy, because I mean you come from the insurance world, right? So you know about everything about risk and everything that comes with it. But the fact that a company like Oka exists sounds on one hand like an important instrument to validate credits and to ensure their promise. On the other, it is also feels like a failure of certification bodies that didn't do their job properly. So my question is, would Oka exist today without the scandals or the missteps of major registries? And is it fair to say that beyond financial performance and reputational risk, there is a fourth poker category that we should acknowledge, which is certification risk?
Some interesting questions there. So would we exist if the scandals hadn't appeared? I actually built the thesis around this market before the scandals hit. I actually thought the scandals would accelerate an awareness and understanding of how insurance could play a role. That hasn't been the case. And I think it hasn't been the case because, back to my point, insurance doesn't solve some of the market design problems. It can work alongside the registries, that if the performance of a credit is not shown to be a ton of carbon, then it can course correct. But it can't provide a stamp of it will always be a ton of carbon stored. So I think, again, just making sure that we've got that distinction around how insurance can work after the event. It can provide some comfort to buyers that if it's found out that credit isn't a ton of carbon, that they can course correct, they can be paid out and replace those credits with other credits that might equal a ton of carbon or add up to a ton of carbon. But it can't provide upfront guarantees around this will always be a ton of carbon. And I think that's the standards body's role. And it's the standards body's failure to address these critical pieces of the market design that is holding the market back. Because if I was sat in a corporate,
Very good angle.
I'd seen the scandals, and even though I knew I could insure those projects, look, it's philanthropic effort, and I'm being criticized for my philanthropic investments into trying to decarbonize. And in no other part of the organization, when I'm donating to a local hospital, am I criticized for that effort? And yet the strive for perfection in climate, the strive for, hold on a second, we're going to hold your organization up. And okay, you might have said you're going to achieve X, and you're using credit instruments, found out that that project has failed to deliver. Well, that's not a corporate's necessarily fault. That's a market design fault. And what's happening in the carbon market is because of those criticisms, because of the challenges that the market has not solved, and I would say the standards bodies haven't solved, corporates are stepping back and go, we're not going to step into this market because I'm not willing to put our head above the parapet. Well, that is not a good solution for us, like societally, globally, is it? So I think, again, it comes down to I'm a pragmatist and a realist. So I'm always about finding problems, putting solutions in place, and moving the conversation forward. We can't strive for perfection is the enemy of the good. That famous state. Like, we just got to keep moving the conversation forward and trying to find solutions that help enable capital to be deployed. And these projects are important. Like, if we're going to take carbon out of the atmosphere, we need them. So how do we find ways of doing it? So the problem sits in the market design. The problem sits with, how do we provide enough comfort to buyers that the efforts of them investing in these projects are going some way in meeting the decarbonization targets that they've got? And then how do we have mechanisms in place that if it's found that they are to be failing, there is a way of compensating, remedying, and continuing to invest, rather than this, okay, we designed something now, we think it's perfect. All right, issue happens. Okay, right, we're going to redesign it, and now it's going to be perfect again. Oh no, it's found to be failing. Okay, we're going to redesign it again. It's preferred. It's madness.
Should evolve in parallel with the science. That's basically, in a nutshell, what you say. And it is a very good and true statement. But again, you have to think that there's been such an incredible amount of emotional energy that goes into the overall climate narrative and literature, that if I want to keep going using your example, nobody has ever questioned me or raised any concern if I donate to the hospital. You don't put that donation as at the base of one of your marketing strategy. Okay, you may, obviously, nobody's stopping you, but on the other hand, corporations, they do that. Okay, and what we do consult to our clients, say everything that you put on word out in the public has to be backed by data, kick-ass, good quality data. Hence all that emotional thing that comes up with it. So, I mean, I do understand it is something that it is evolving. We have technologies that are evolving. I still cannot fathom how we are wrapping our hands around on how to calculate the amount of CO2 absorbed by a tree, to be honest. But it is something that it will move on, it will arrive. But you didn't answer on my second part of the question, which is the certification risk. Okay, is it something that it should be observed? It is the market. It is plenty of green labels, green certification left and right. Thank God you have some that are really good, really with the standards behind the vets, everything. Okay, really others that they are not worth the paper they're printed on. So is there also a fourth risk, the certification one?
There is. And look, again, we should make it clear, when we put insurance products out into the market, we probably are quoting on maybe 10 to 15% of the risks that get presented to us because of the risk. If you look at these buckets of risk, whether it's political risk, whether it's the climate risk related to a project, whether it's the certification risk, whether it's the eligibility of this project to meet the standards, that you put them into these buckets, and then you look at a project and look, that incredibly early stage usually. There's a whole host of technology risk as well added into that, or or operational risk to get the project off the ground, they're early stage, insurance just doesn't play a very good role at taking what is effectively equity risk. If I use a comparison within the clean energy space, if you look at wind and solar, like early stage wind and solar projects, that was equity risk. People seeing that this was a new wave of renewables, seeing, okay, high development costs, high output power costs. But if you looked at the curve, a belief that as there was economies of scale, as there was scientific improvements, as you came down the curve, that actually then the ability to replace traditional coal, gas power, that renewables would become cheap enough and the scale up efficiencies would grow. And then the benefits from a equity investor would be delivered. So that's early stage equity risk. And then where insurance came in is when it started to scale out, when you've got this repeatable models of, okay, it's a 3 wind turbines, we want to scale to 100. Okay, right, you're bringing debt. And that's what scales markets, is institutional debt capital. When you've gone through those early stage equity, you've gone into opportunities outside of the sort of philanthropic or foundational impact, and you're into sort of debt, that's when insurance can really play a role, because as an early stage data has started to come about, you've seen the risks around, does the wind blow? Can we guarantee the performance? Can we guarantee the output? Does the infrastructure delivering that into the grid work? All of that has got developed over a 10 to 15 year period. And now the insurance market for wind and solar is huge, well saturated, growing market, brilliant. That's along the adoption curve of technologies, wind and solar are right on the right curve, where insurance is a prosperous market with loads of markets and loads of capacity. As you come back down that curve, as you come to, battery storage, as you come to clean hydrogen, as you come to mini nuclear, carbon is just like right at the early stages. Availability of data, proof points around the predictability of carbon projects, the science around carbon being stored, the political risk exposure of these projects and where they're being developed, the robustness of the state of the standards bodies. So I think we're just at the starting point, I guess, and we get presented a lot with equity risk type ideas. Or could you come in to this project? We're thinking of investing. Could we insure it with you? You take all that risk off the table for us. It's like, well, I don't get any of the upside if this project scales out. We can come in at a later stage. So again, it comes back to my point. We're one part of the tool set for the carbon markets to scale, and they are starting to put some of the other pieces that are in place. Standards bodies are starting to modernize. Tax regimes are starting to come in place where credits can be allowed into that compliance scheme, but only if it meets these standards. You've got rating agencies assessing the projects. You've got the quality of data. Your point, Francesca, around measuring carbon in a tree, that has improved. It's no longer people going out and sort of, tree by tree
measuring the diameter. Yeah.
It's improved the technology and the science. So I think we're at an evolution of the carbon market, and confidence is starting to be built in some pockets of it that we're solving some of those problems, but we're not there yet.
Can I ask you a question, Chris, about time? Because what I'm really reflecting on here is that other startups I work with starting to feel a bit 3D, and yours is starting to feel 4D. You've got this fourth dimension of time in here, because you're insuring today, but you're insuring into the future. And I want to know, how long do you insure for, but also how are you accounting for not just the risks of the projects that are happening now deteriorating over time, but additional climate risks coming into play that start to change your business model in time, in the future? That time feels like that's a whole new element to be thinking of here.
Yeah, 100%. But again, from an insurance standpoint, not a new concept. Again, back to my construction of a hotel, might take 5 to 7 years for it to actually come to fruition. So insurers are comfortable with taking long-term risk and looking at duration of coverage and exposures that may develop over a period of time.
Startups, aren't they?
We're a well-backed startup with insurance expertise, with capacity that we put together, and startups in insurance. And this is a very specific insight, I guess, into the insurance. Like, you'd expect big insurers to be the ones that innovate in insurance.
No.
They're the ones that are the most risk averse, because they even though they've got the largest balance sheets, their ability to innovate around product is incredibly restrictive, because of the data sets and the models that they built. So it takes, for innovation with the insurance space, new entrants to build, to prove out a model, and then to build the capacity behind that to then bring insurers in. Did it in a previous life within a very different space, within a small commercial market, proved a different model, proved a different distribution model, proved a new underwriting model, and then the large players come in. And it happens time and time again in insurance. So it's not an unfamiliar space for me, but also not an unfamiliar space that we're having to use proxies for risk data that haven't been done before. But again, like, into a secret, like, most insurance has been done. It's just, how you put the risks together, whether it's space travel, whether it's blockchain, whether it's climate. Many of the types of risks that we're looking at have been looked at before in a different context. You're just looking at it with a different lens. So, if you've got a project that is in sub-Saharan Africa, the political risk of a big infrastructure project has been looked at. It just happens to be that this is a carbon project. So you take some of that political risk exposure and you go, okay, well, that's very similar. It's will the government, adhere to the things that they said they're going to do, whether it's a oil field that's being developed or whether it's a carbon project. So I think it's a way that startups have to innovate in insurance, really.
Chris, I want to hear about the dodgiest ever project that came to your desk. Like one so bad, so dodgy, that made your perfect beard shaking. It's that bad.
It's a long time to curate this beard in the morning. So, the dodgiest. I mean, it's interesting. Maybe this isn't a direct answer to your question, but we've insured projects that have subsequently been found to have issues in relation to them. So there was a project in Indonesia that's been well reported, that the project was confiscated by the country. So credits that have been issued from that project and bought by many corporates around the world are not worth the penny or the dollar that they paid for them. But I go back to the issue. So we insured them. We insured them against the invalidation of those credits. So if a corporate had come to us and said, look, it's now been found out that these credits have been invalidated, we want to file a claim, we would have paid that claim because we insured that project, believing it was a good project, believing the political risk was minimal, priced the projects and provide coverage on those credits. Back to the problem in the market, but the registry didn't do anything. They put the project under review. The project has been under review for quite some time and nothing has happened to that project. So those credits are still active in the market and have not been invalidated. If it was me, the standards body, I would go in and invalidate those credits, and I would be saying to the corporates that those credits are no longer worth what you paid for them and you now need to replace them. But that's back to the responsibilities for action in the market have not been taken. So that's maybe not a direct answer in terms of a dodgy project. So we thought it was a good project, and it happened to be that the project was found to be, there was an external event that meant that those credits are not worth anything. We definitely have projects coming to us that are substandard in terms of the governance that have been put around them, around the viability of that project getting to producing credits. Again, quite often not to the fault of the developer. It's more often to the fact of they're on this journey, they're signing up to terms because they just got to they want to get their project live. They're pretty punitive, and we look at it and probably the project's not going to survive. So we can't insure those. We can't insure the project because we just don't think the credits are going to stand the test of time. And there's quite a lot of that in the market because it's a under-demanded, oversupplied market on the voluntary side today. And I would say we're going to have to see some consolidation and probably some projects fall away as the market gets rebuilt.
Have you had to make any payouts yet? And if you did, would you make them in cash or would you make them in other credits?
Really good question. And probably, we could spend 20 minutes on the settlement method. We pay out in cash. We've not had to pay any claims yet. We've set reserves against that project because we think that should pay out, but it's yet to pay out. And we pay out in cash because we believe that's the best way of bringing significant insurance capital into the market. If you have to also assess the reserves as an insurer, you have to put cash aside to be able to pay claims out in the future. If you're holding that instead in credits, then how do you make sure that those credits are not compounded by the impact of you're holding the same credit type as the project that's insured? How do you make sure that those credits are not impaired in some way? You add in an asset management challenge to the model that I think is overcomplicating the solution. And the solution is, let me pay you as the developer that's developing the project to keep the project going, or let us pay you as the off-taker that's buying those credits. That's been found those credits are now worthless, and allow you to go out and replace those credits and uphold those commitments you're making, or pay the tax that maybe you now need to pay because you were using those credits instead of paying a tax.
Very interesting, Chris. You said something about the overabundance of some of those credits. I'm hearing a lot, especially in the recent months, about the Corsia carbon credits for the aviation industry, as the sustainable aviation fuel is behind in terms of production, second only to nuclear fusion, probably. What I wanted to ask you, it is, do you think, or which particular tech or industry do you see will have a fairly healthy growth in terms of carbon credit generation in the short future?
I'm glad you pulled out the Corsia airline scheme, because I think that as I look at where is demand going to come from for carbon credits, I think that's a blueprint for how other quasi-compliance or compliance schemes are going to develop. And 30 airlines come together, decarbonization targets, 1st of January 2027. They then enter a compliance. They're in a sort of test phase at the moment, and huge demand expected because, as you say, flights have increased. Predictions on this market in the last couple of weeks have increased 25%. So there's going to be huge demand for airlines to offset those emissions or face penalties from their host country. And the supply of credits to meet that demand is likely to come from a couple of big project types, things like clean cooking, water purification. We will see most of the supply probably in Africa and Southeast Asia in the near term. And it's a combination of the volume of credits you can generate from those projects as well as the cost. You're not going to be able to, if an airline has to buy, a couple of million credits to get them from some of the more engineered solutions at $800 to $1,000, it's just not viable.
Yeah.
If you're looking at clean cook stove project where the credits might be $20, then I think that's the most likely demand and supply opportunity, I think, for the carbon market. I think what's really interesting, Francesco, is that some of the challenges and system design problems that have existed today are starting to be solved, because what ICAO, the airline governing body, has done is said, look, carbon market, you need to solve some of these. There's a very specific problem they've said, is like this double counting issue. We can't have our airlines buy credits and then host countries also use those credits. So you need to make sure that if a developer sold those credits to an airline, that they can be used by the airline and they're not being used by the country. If they are used by the country, there needs to be a compensation mechanism. Something needs to happen. So we as an insurer, as a front leader in this market design, have designed a product specifically for that, which effectively means that If it's been double counted, a developer will have to replace the credit with another CoreCia credit, and we will pay that developer to do that. So it's a beautiful way of solving a very clear risk problem with a solution that helps maintain the integrity of the system. So an airline won't even know about it. An airline will have bought 1 million credits. Let's say 100,000 of them are found to be double counted. Those 100,000 behind the scenes, a developer will have to go and find and buy another 100,000 credits, either from their own supplier out in the market, and replace those credits to make the system whole. That's a great example, I think, of the market design fulfilling and satisfying some of these integrity questions. So if, reporter picks it up at some point and goes, AirAsia, you said you were meeting your compliance targets, but we found that, hold on a second, this project that you bought from, actually, Zimbabwe has used all of those credits for their own NDC. Well, okay, there's a mechanism here where actually they will have replaced those credits, and the airline can still go, nope, we've still met our compliance needs and our requirements. So it could be a blueprint for how the market moves forward in other spaces as well.
You know what surprised me, Chris? While you were talking and you mentioned about countries, I was thinking this should be a priority for countries, for governments, because considering that, I don't know, 3/4 of the world nations are in debt, they have inflating, ever-growing debts, and terrible balance sheets. This should be for them an incredible, if properly regulated, obviously, should be an incredible opportunity to generate income without adding on taxes. So,
my motivation for building my third business within the climate space and deciding to step into this crazy world of carbon is in part answered by that statement. This is an opportunity to direct capital from those that have created some of these problems to countries that have the natural resources and have a need. And I think countries are waking up to that. I went on a tour last year of a number of projects in Rwanda, in Kenya, in South Africa, and you're seeing, I think these countries are starting to wake up to the opportunity of directing climate finance and being a vehicle for directing capital inflows into their countries. Setting up the right regulation, putting in place the right structures, supporting the project developers to get these projects live. And it's not just the climate benefits, but equally they're seeing the social and health benefits that are also coming to their communities. So for me, that's the motivation here. It's that, we can find a way of trying to enabling this market to scale. Again, no silver bullet, but it's about moving some of these big problems forward a little bit. Is aspiration that hopefully we as a team are trying to help sort of facilitate.
Well, I know, I was just going to say that's a lovely, inspiring story. I've just been inspired by insurance. Never thought that was going to happen.
You this morning on a Tuesday afternoon, insurance is, back to my social good point. It's exactly why insurance came about in the first place, was to try and enable some of that risk, some of that capital flow to happen.
Look, I've seen the uptick in interest in carbon credits, the rebound in carbon credit in the past 3-6 months, no more than that. Post, let's say, that purgatory, post scandals. And now, because of the CoreCia, it is the most that I'm hearing around in terms of requirements, in terms of pricing. I'm hearing like incredible pricing for certain projects on the scale of direct air capture that these airlines are happy to pay for these projects. I'm pragmatic like yourself. For me, it's all about the numbers. If the numbers make sense from a removal standpoint, those should have the priority compared to the avoidance one, because the net drawdown and sequestration is certainly higher. But if this is an instrument that helps in achieving what we all need to achieve, and it is done not in a dodgy way, why not?
Now, I wanted to just, before you stop recording, Francesco, give us an opportunity to slice and dice it there. But I feel like you left an Easter egg on the table back there when we were talking earlier. Carbon tax. You said you'd want a carbon tax. Chris, why would you want a carbon tax?
It's a very simple response to that. It's taxing the externality. So, the only way I think we're going to get as a planet, that we're going to solve some of these problems is pricing that externality, and carbon emissions will drive, if taxed, will drive change. So I think it's a very simple equation. I think.
Do you feel that we've got the right measurements and tools and bodies now in place that we could actually effectively do that? And would it be international?
I think we've got enough of the EU ETS is a prime example of how it has worked. If you look at emissions levels across the EU bloc and what has happened with that cap and trade system, it has been a huge success. Why can that not be replicated globally and give us an opportunity to make progress towards what we're all trying to achieve? So I think we've got the tools. Are they perfect? No. Do they need to improve? Yes. But I think we've got the opportunity, and I'm an optimist by heart. So I always live in hope that the carrot will be great enough for humans to aspire to change. But in some circumstances, I think you need the stick. And I think this is a classic example, I think, where tax should play a role to drive action.
Nice. Thank you very much. I just wanted to capture that before we lost you. Many, many years ago, I was involved in some work around the EU ETS, and Jos Delbeke is known as the grandfather of the EU to EU ETS. And in the midst of a big event in the evening with various drinks involved, I sat on his lap. He was mortified. But I'll almost take that as a bit of a credit.
We're still recording, right?
Yeah, I know. But you're cutting that bit out.
This is going live. This is going.
He hadn't actually launched it at that point, so we didn't know if it was really going to work, or he just had, but we weren't sure if it was going to work. And now I hear it being credited as one of the best things to happen in climate, and I'm thinking, yeah, lovely guy.
Oh, that's good to hear. It's always nice not that they're sitting on the lap, but certainly the nice guy part. Because I think, people with good intentions sometimes get clouded by the problems that they're trying to solve, or they, get beaten down. And, that's good.
Or by somebody sitting on their laps.
Well, importantly, I've remembered his name. I feel as though it's one of those things. If you're going to do something big in the world, you should have people remember your name. It's not quite the Nobel Peace Prize, but do him a service. Maybe we'll remember your name, Chris, when Ochre's got big and the whole carbon credits has really taken off and everything sort of established itself in a world of regeneration.
There we go. I hope not. I hope that it's not, that we're just a starting point for a catalogue of inventions and change. That's, You're
right that we need lots of things, but we need the starting points. Otherwise, we're never going to get it going. I see some really, really exciting things happening around. It started with sort of ecosystem services, and it's now moving into nature-based solutions. And importantly, financial models that enable nature-based solutions to start to be investable, profitable, and worthwhile. And we're moving into that space now, finally. And you're going to be a big part of that. Yeah,
exactly. Like the matching assets to liabilities, and nature being priced as an asset that you can, the pension funds. That's exactly right. And I think that, and again, the Europeans are leading the way. I think that the big asset managers are starting to do that, aren't they? So it's great.
Thank you, everyone.
Thank you, Francesca.
I'll catch up with you soon.
For God's sake, stop recording.
Yeah, you stop asking questions, though. Thanks for listening to this episode of Raw Green. If you made it this far, you probably enjoyed it. So don't forget to hit subscribe and follow our podcast. It's an awesome way to support our community. At Obi, we're all about research, life cycle assessment, and the green tech innovation. Stay in touch through our socials or visit our website. Links are ready for you in the description. Catch you in the next episode. Ciiiao.